Okay, welcome everyone. This is Scott here again with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And this is my next live option trading video. And in this one, we're going to go over my current position so you can see where everything is at. And then I'm going to spend some time and talk about something very cool that happened with Virgin Galactic that proves my point and my research regarding the profitability of selling options. So stay tuned for the full video to see that. And today is a good day because I finally get to take off my abysmal trade on TAL Education Group. Right, if you've seen my other live option trading videos, then you'll know I've had this position on for quite some time, about a month and a half. And specifically, I am short 2 naked put options that are super deep in the money at the 35 strike. And you can see right now TAL is at just under 20 bucks per share. So like I said, this has been a very terrible trade. That being said, it could have been a lot worse if I did not hedge this position correctly, but because I did so, I am going to save myself quite a bit of money. Still going to realize a loss once I take this position off today, but at least it won't be nearly as bad as it could have been. Now, I did also place one new trade this week on Nordstrom, and so right now I'm going to stop here and play a clip from a few days ago so you can see what I did to put on that new trade. But as always, before I do so, I just want to say for those of you who are new to the channel that I do also teach on SKILLSHARE, where you can take my very in-depth classes on options trading and stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for Skillshare using any of those links, you'll get a 2-week free trial. Okay, so with that being said, I'm going to go ahead and play that clip now. Okay, today is Monday, July 12th, and the stock I'm looking at here is Nordstrom. And the reason being, if we come down here, we're seeing a pretty big spike in implied volatility today, all the way up to around 77% or so. And it seems perhaps the reason being is there was a bit of news that came out this morning. You can see Nordstrom buys minority stake in Topshop, Topman, Miss Selfridge, HIT Brands, etc., for an undisclosed sum. So for whatever reason, the market is interpreting this news as causing more uncertainty about the stock's future, about Nordstrom's future that is, right? And that's because of the many ways to interpret implied volatility. One such way is that it's a measure of fear or uncertainty about whatever stock that you're looking at. So as a result, we have an IV rank of 37%. That's not bad. An IV percentile of 44%. That's a bit lower than where I would like it to be, but still close enough to 50%. That's generally my cutoff, but like I said, close enough. And also the implied volatility just in general at 77% is very good. So that means the options on Nordstrom should be relatively expensive and therefore advantageous to be selling them. And now if we come over to the chart, let me expand this back down again, and this one here too. So you can see in the chart here, this stock has been pretty much range bound for the past several months. And the trade I'm going to make here is going to bank on this sideways price action continuing for some time longer, maybe a few weeks or months. So basically I'm going to sell a strangle here, but I am going to allow for some more room on the upside because as you can see in the past, this stock has shown multiple times of maybe a bit of a short squeeze or just a brief moment of pretty extreme euphoria. And so I don't want my call options to be too close. So let's come back to the trade tab here and we'll take a look at the options. As you can see, I'm in the August expiration cycle and I'm looking at potentially selling the 45 strike call option and the 35 strike put option. So with the delta of my put option at 39 and the delta of my call option at 15, this is definitely a bullish skewed strangle, although it's pretty moderate. And if I go ahead and set this order so you can see the credit I would take in for selling these strangles, go to strangle, sell one contract, 45 strike call option, sell one contract, going to be the 35 strike put option, there we go. And as you can see, I would collect 236 bucks per strangle that I would sell, and I would sell 2 of them here. So this credit pushes my break-even points a full $2.36 above my call strike and then below my put strike. So back to the charts here, my break-even point on the upside is at around $47.36, just a bit above the peak, this peak right here back in March. And then on the downside, my break-even point is at $32.64, which is right around here at this level, which is at the base or at the major support level of this entire range. And so that's what I'm aiming for. I want the break-even points to cover the high and the low of this entire range over the past few months. Because like I said, I do think this sideways price action will continue at least for some more time. And then again, because of these few moments, I want to keep my call options a bit further away. So back to the trade tab and we'll make this trade official. And also I did verify that this stock does not have earnings until August 24th, which is after the August expiration date. That's awesome. So finally, I'm going to set this to 2 contracts each, which brings my total credit to $468. We'll go to confirm and send. And the buying power effect is $1,200. That's totally fine. And we'll go to send. And just got filled immediately at 234. Awesome. And then real quick, last thing to do is set up the buying order to take my profits if I'm correct on this trade. So we're going to buy back the strangle, and we're going to buy back the 2 contracts each, 45 strike call option and 35 strike put option. There we go. And half of 234 is 117. That's the price at which I'm going to buy back these strangles for, make it a GTC order, and there we go. Confirm and send, all done. And then finally here, I want to update you on 2 positions I just took off this morning. You can see I bought back my Bed Bath & Beyond strangle and also my Seagate Technology naked put option. So real quick, let's go to the Bed Bath & Beyond chart, BBBY. So if you may recall, because I have talked about this in a few of my other live option trading videos, this was an earnings play I made. I sold a strangle, and you can see those earnings came out right here on June 30th. And as of today, the stock is pretty much at the exact same price where it opened after those earnings figures came out. So basically with no price change and also a contraction in implied volatility combined with time decay, because time always eats away at the value of options, all those 3 things together finally allowed me to take my position off for a full profit. And then the other one was Seagate Technology, so STX. This was the stock where I sold a naked put option right when it hit this support level at around $83 per share. So at this point, I was banking on a bit of a bounce off of that support level. And I did get my bounce, although it definitely was not as strong as I would have thought it would be. So this trade did take some more time to play out than I originally thought. But today, with the stock being up by about 73 cents, I was also finally able to take that trade off for a full profit. Okay, welcome back. I hope you enjoyed that clip on my new trade in Nordstrom. And so first, let's go to the Nordstrom chart and we can see where the position's at today. And so far, this trade is not working out too well because Nordstrom has sold off 1, 2, 3, 4 days in a row. And I did sell a bullish skewed strangle, but I'm not worried at all yet because I do think Nordstrom is just coming down and testing the lower end of this range right here. I kind of expected this, to be honest. And so now over the next few days or perhaps the next week or 2, I do expect to see a bit of a reversal. And I would like to see Nordstrom stock come back and breach this former peak over here around $37. Because if that happens, let's say Nordstrom goes to 38 or 39, then at that point we would see a sequence of higher highs and higher lows, which would point to just a very gradual climb higher for Nordstrom. And that's what I want to see. So at this point, there's still plenty of time left to go in the expiration cycle. I am in the August cycle for this position, and there's still 35 days left to go. So plenty of time for this position to turn around. Let's come back to the monitor tab now. And so of course you can see once again, I am down today on TAL. This is pretty much what I've seen almost every single day since I put on this position. So I'm very pleased to get rid of it today, although I will continue to hold onto it until the end of today. You never know, we could see a bit of a reversal at some point in the afternoon and I could make this money back. So I'm going to give it as much time as possible. My XBI put credit spread is still underwater. Let's come back to the charts real quick and take a look at that. XBI. So yeah, as you can see, a lot of my bullish positions are giving me a hard time right now. And it does feel like I'm in a bit of a losing streak at the moment. And that's just what happens sometimes when you continually play the odds in the stock market by selling options, or when you play the odds just in general, right? Even for professional blackjack players who can actually count cards and still win on average, they will hit losing streaks as well. And even still, I would not call this a losing streak because this trade, just like my Nordstrom position, still has a lot of time left to go. This is also in the August expiration cycle with 35 days left. So anything can happen between now and then. It just seems that as of right now, currently, a lot of my positions are just not doing well. And again, that also comes back to the point I like to make, which is to always keep your trade size small so that when things do go wrong in the short term or at some point throughout the expiration cycle, you can continue to hold on to the trade and wait for things to come back around. And in fact, I think the best case study, which really proves my point that most of the time the stock does come back around by the expiration date, would be to look at Virgin Galactic, and I'll show you that in a second. So at this point, nothing to do, just hold on and wait, especially given that this is a defined risk position with a put credit spread. I'm just going to hold this all the way to the expiration date and see what happens. Let's come back. Now my one good position currently is my EWZ strangle. Let's take a look at that chart real quick. EWZ. So basically, I'm banking that this stock is going to stay somewhere in between these two trend lines, which are acting as resistance and support. And so far, I've been correct on this trade in that I do think in the short term, the stock is going to, or this ETF, I should say, is going to work its way down to the support level down here. So we saw this big dip down lower, a short-term rally, and now it looks like we're about to turn back around and go lower again. So everything looks good here at the moment. Let's come back. Next up, we have my clean energy position, which is also going to come off today along with TAL. That's because these options are going to expire at the market close. And unfortunately, this position has also turned south. Let's come back to the CLNE charts. So much like TAL, this stock has done nothing but just go lower for the past several weeks, pretty much for the entire past month. And so if I come to the trade tab real quick, you can see that in the July cycle, my put option is now well in the money at the 11 strike. And so with the stock at 7.5, like I said, this position has turned south in a pretty bad way, but honestly, the losses on this one are not too bad. Right, if we come back to the monitor tab, you can see on this position, I'm going to take about a $300 loss. That's actually totally fine, considering my average profit per trade, profit per winning trade, is about 150 to 200, and my win rate is still above 80%. So with a win rate as high as that, and with average profits around $300, a little bit less, then taking losses around this magnitude is actually really no big deal at all. This is just part of the game. Losses are always inevitable. It's just the big losses like on TAL or on Virgin Galactic that I had recently that can really set you back a few weeks or a few months. Which is why it's always very important to hedge or adjust your losing positions, especially the very bad ones, so you can limit the losses as much as possible. Right, so very quickly here, I'll expand this tab, and I've shown this in my other videos before, but I'll show it again here. You can see on just my 35 strike put options, which is where I started with initially on this position, on just those puts, I'm down $2,500. That totally sucks. But I have two different hedges on this position. You can see I'm also short two 37.5 strike call options, and I'm up about $115 on those contracts. So that helps a little bit in canceling out the losses on my put options. And then I'm also short 150 shares of stock, and on this hedge, I'm up over $900. So combined here, that means my hedge has saved me over $1,000. And so yes, losses like this, like on TAL, which in the end is going to be around $1,500 in total in the end, most likely. These kinds of losses do set you back pretty significantly. But the good news is they don't happen very often. And also, like I said, if you can hedge these kinds of positions correctly and reduce your losses in a significant way, that's obviously going to help you bounce back a lot more quickly. Next up, we have my MU strangle, which is also underwater by a little bit. Like I said, at the moment, I'm definitely in the middle of a cold streak, but these positions still have a lot of time left to go, so I'm not worried yet. Let's come back to the charts, MU, and there we go. You can see this stock over the past few days, just like a lot of my other bullish positions, has just kind of gone lower. But just like Nordstrom, I do think that as of now, the stock is reaching the lower end of this range for the past couple months. So I do expect over the next couple of days or the next week or two to see a reversal and for the stock to finally start climbing back higher. Right? You can see the same exact kind of pattern played out just a few weeks ago here, and look what happened. Once it made a low, we had 1, 2, 3, 4, 5, 6 up days in a row, one tiny down day, and then another up day. Now, of course, I do understand that you cannot use the past to always and reliably predict the future. The future is still completely unknown. But I do at least think the odds at this point do favor a reversal back higher. That's all I'm saying. And so I believe that's it in terms of my current positions. The last one I have is Nordstrom, and we already covered that one. So I'm definitely pretty light on positions right now, and I'm doing that intentionally, especially after today, considering my clean energy position will be gone along with TAL. So that will just leave me with XBI, EWZ, MU, and JWN. And the reason why I'm winding down my positions currently is because I'm gearing up for earnings that are starting in bulk next week. Right, if I come to the Market Watch tab here, and let's sort this list by the IV rank, you can see all these blue and red dots for all these companies indicate earnings that are on the horizon. And I think I'm going to make a video about this topic over the weekend and upload it next week so you can see my exact thought process and commentary around earning seasons, because this is actually one of my favorite times to be selling options. So stay tuned for that video. And so that does mean I'm probably not going to put on any new positions today because there are a lot of earnings coming up specifically next week. And so I want to reserve my capital to play those earnings announcements. But I did mention I do want to talk about briefly Virgin Galactic. And so I did have a strangle on the stock, which I did take off on Monday, I believe, right? As I mentioned last week, the implied volatility for this stock was skyrocketing because of their big launch that happened this past weekend, where Russell Branson himself actually was participating in the launch and went into space. So there's a lot of uncertainty and perhaps a bit of fear around that event, causing the implied volatility to skyrocket. And so as I mentioned, I did have a short strangle on the stock. Specifically, I was short the 75 strike call option way up here, actually here, the 75 strike call option. And then also I was short the 42 strike put option, which you can see now would have been super far in the money. And so what happened was on Monday, after the success of the launch, I was expecting implied volatility to come down, and that's exactly what happened, but I was not expecting the stock to just plummet every single day. So I believe this huge red bar right here was the price action from Monday, and it was on this day when I saw this huge collapse in the stock price that I just said, screw it, I'm going to take off my position for a small profit and just walk away. And so even with this big down move that pretty much ended right below my short put strike, right? Again, keep in mind my put was at 42, and on Monday alone, the stock came all the way down to a low of just under 40. So even with this massive down move, because implied volatility contracted so much, that's why, like I said, I was able to take a small profit on the position and just move on. Now, what I want to emphasize here is the fact that before I made that trade, before I sold that strangle on Virgin Galactic, I did have a trade before that on the stock where I sold 2 naked call options. And so I believe it was all the way back here on May 24th, somewhere around this time, where I sold 2 naked call options on this stock. And I sold those call options at the 30 strike right here. Now, based on my own research, based on the research from Tasty Trade, and based on my own experience, what I have seen is the vast majority of the time, when you sell out of the money option contracts, which at the time, these 30 strike call options were out of the money by like a full $6 or $7, the majority of the time, even when your strikes get breached, the stock eventually comes back by the expiration date. Does not always happen. Clearly, as you can see from my positions on TAL and clean energy, it does not always happen, but the majority of the time, I would say it does. And again, I'm basing that answer on actual research. And I'll post a card above linking to my video on that specific research I did on how often short strangles turn a profit by the expiration date. I think you'll find that to be very interesting. And so even for a total meme stock like Virgin Galactic, where at the time when I sold those call options, Virgin was around $24 per share, let's say. This stock went from 24, blew through my strikes at 30, and went all the way to just under 60. It almost doubled my strike price. And now look what happened. Today's the expiration day for those July contracts that I sold, and the stock is back down to $30.85. Less than $1 above my call strikes. Now, unfortunately, I did have to close this position early for a pretty nasty loss because it was on this day where on the open, the stock gapped up by over 20% and then just exploded higher. Specifically because of this massive gap here, I totally missed or did not even have the opportunity to hedge my call options in the way I wanted to, right? I was trying to hedge these calls by buying shares of stock at certain price points. But when the stock gaps like this on the open, you obviously cannot buy the stock at the price point that you want if the stock gapped over it. So when this happened and I missed my opportunity to hedge the position further, the losses on my naked calls reached a point that I was no longer comfortable with. I was down more money than I ever expected to. And so in rare cases like this, I just had to close the position and move on. Because like I said, this is a meme stock. This could have gone from 60 to 70, 80, 100, who knows? And there was no way I was going to continue holding on to this position with a totally botched hedge. Of course, in hindsight, I do wish I had just held on to those contracts, of course. Hindsight is always 20/20, but this definitely still proves my point that if you can hold on to a position, specifically a very high probability position like selling out of the money options, if you can hold and manage that position all the way to the expiration date if you have to, chances are that by the expiration date, the stock will come back. Maybe not all the way, but at least by a pretty decent amount. So I think it's pretty amazing to see this, specifically when you come to the trade tab and you look at the actual probabilities of these options being in the money by the expiration date. That's what all these percentages mean. So for example, on these July contracts, which expire at the end of today, the 32 strike call option here has about a 19% chance of expiring in the money come the market close. Or in the case of these August contracts that expire in 35 days. The 38 strike call option has about a 21% chance of being in the money by the August expiration date. And these percentages, these probabilities are pretty accurate. But you do have to keep in mind that these probabilities correspond to the expiration date, right? A 21% chance that Virgin Galactic could be above $38 per share by the expiration date. And anything can happen in between. The stock can go to $5 per share, explode to $100 per share, come back down. All that matters is what happens by the expiration date. So if you are pursuing an option selling approach like myself and you do have some pretty bad losing positions, then don't lose faith. Be mechanical, adjust your positions or hedge your positions accordingly to keep your losses small. Because of course, sometimes the stock will never come back, but most of the time it will. So just hang on, be patient, and keep your trade size small to begin with, and you'll be fine. And so with that being said, that's going to do it for this video. I hope you enjoyed it. And please let me know your thoughts or if you got questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading and stock market investing, then check out my SKILLSHARE courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.